Good morning, gents. Good morning, Jax. This is File. Today is Tuesday, March 2nd. Let's get started. Okay, so today I'm just going to provide earnings preview for FUBO TV, symbol FUBO. This is reporting earnings tonight after market close. I'm long the stock, and I plan on holding full position going into earnings tonight. So just to get that out of the way, I'm bullish on the stock, I'm long the stock, and I plan on holding this. And if this comes in for any reason and sells off, I plan to actually add to my position tomorrow, but I don't really expect that to happen. Now, with that said, here's a couple things that you need to keep in mind. Number one, let's walk through this chart because this has been such a volatile stock for the past 3 to 4 months. Let's start off when this company last time reported earnings, which was on November 10th. And at that time, this was rarely on anyone's radar. And this stock was trading around $15 to $16 per share. A behind the numbers post was made by Jay on homepage after that earnings report came out. So you can take a brief look at that to kind of get yourself familiar, but I'll read you the highlights here. The company reported that they ended the third quarter with 455,000 subscribers, which was above their own guidance of 435,000 subscribers and well above a street estimate of 375,000. They also mentioned that their advertising ARPU, or average revenue per user, increased to $7.54, which was significantly above the consensus view of $6.52. All of that combined led to revenue, subscription revenues rising to 53 million, more than 10% above the consensus estimate of 47.7 million. So this was all happening over here. Subsequently, the stock ripped higher sharply. But the reason why it crashed over here in the last 15 days of December was for two reasons. One, there was a 88 million share unlocked after the IPO. This happened in the last 15 days of December. More than about 130 million shares were outstanding, or total outstanding shares, but of that, only 20 million float was actually available. But out of that 130 million, 88 million went through lockup expiration post the IPO. And so as a result, the supply of stock in the market increased dramatically. On top of it, three different short selling shops basically ganged up on the name because it had ran up so much. So basically they had an easy way to attack it because the supply of shares was already increasing. As a result, the stock had a monumental decline, declining sharply from 62 all the way to 25. It stabilized over here, and then it started to bounce around. This was the first time when we turned bullish. We turned bullish here too, but then as it came back here, we recommended an official trade idea, and then we made money along the way as well. Now, here is what you need to know going into earnings tonight. As you can see, first of all, purely technically speaking, this stock is once again sitting at an important trend support here and starting to bounce off this level. Although the volume is very light, well, we'll see exactly how this will play out today. MACD and RSI have corrected, and RSI starting to climb slightly higher. Going into earnings tonight, the most important metric is exactly the paid subscribers. If you look at the fourth quarter that will be reported earnings tonight, the consensus is looking for 548,000 versus management guidance of 545,000. So this is what they're looking at. But then, and they're also expecting ARPU of 65.21. But then for Q1, the street is expecting a sequential decline sharply. They expect that the paid subscription numbers will come down from Q4 to Q1 from 548,000 to 473,000, which would represent about 15% decline in total paid subscriptions quarter over quarter. They also expect that average revenue per user will come down from 65.21 to 64.71. And I believe this is where there's a potential for surprise to the upside. I think the consensus for Q1 is too low, and I think they're going to have to raise that once the earnings reports comes out. So this is where I believe the element of surprise will come from. So the question is, why is the consensus too low for Q1? Why are they looking for a 15% sequential decline? Number one, there is seasonality over here because as soon as the college football and NFL games are over after Super Bowl, then there is generally tends to be a belief that you will see people the churn rate will spike at that particular point. And as a result, you would see some cancellation come in and you will see the total paid subscriber numbers basically come down sequentially quarter over quarter. But is it really going to happen this year? Well, I don't think it's going to happen for a couple reasons. Number one, we're still going through random phases of lockdown. There's a tailwind here still from COVID that is still in play over here that is not fully factored into this. This may be normal to see 15% decline in a typical year, but this is still not a typical year. That's the first thing. Number two, this company is still benefiting from a lot of other metrics outside of football that are benefiting. So, for example, if you look at the schedule of events that are in play over here, they still have this full calendar of March Madness, which is in play. And these are the dates for that. Here's a schedule of all of these March Madness games that are coming up. Selection Day starts from March 14. That's coming up in about 2 weeks. And then we have the first four, and then the first round, second round, Sweet 16. And all of these games are starting in earnest in about 2 weeks from now. This is going to keep people engaged. Number three, they still have the NBA basketball game that is currently in play, which many other networks are not showing because there was a dispute with Turner previously. So they basically pulled the plug. These games are still being played. You can watch them on FUBO, but they're not available anywhere. So that's another positive tailwind. Also, this company going forward is in the first quarter as well as in the second quarter, they're going to be announcing a sports wagering system, which is expected to begin sometime in June and July. And they have already started to put in routes for that. So there have been two announcements that have been made related to that. Number one, on December 1st, they announced acquisition of Balto Sports as a first step into online sports wagering market. And then they followed up a month later with another announcement. This came on January 12th when they accelerated the development of a sports book by acquisition of Victory. So what do you think is going to happen when the earnings conference call starts tonight? When the earnings conference call starts tonight, there will be barrage of questions that you've done two acquisitions to get into the sports betting, which is supposed to launch in June or July of this year. And when that discussion begins, I can figure out why the forward paid subscription numbers would actually be coming down when that discussion begins. If anything, those numbers should actually be going up. I expect management to talk about the timeline of exactly when the sports book is supposed to launch. So putting this all together, and by the way, one more thing, this stock is 29% short interest. 29% short interest going into this earnings tonight. Now, by the way, that 29% short interest is as of February 12th. So I do not know how it was updated and what it currently looks like. I haven't checked as of the end of February. But anyways, 29% is very, very high. If despite all these reasons and all this development and everything, if this thing still comes in, right, then I could see this thing coming back down to $28 to $29 per share, which is the major VOP support level. And at that point, I will add to my position. Otherwise, I'm expecting a bounce from this trend support back up to mid 40s or even $50 per share. Lastly, I would also add just a few other developments that many people are not aware of. FUBO did some interesting improvements, product improvement in the last couple of months. I do not know how much that will affect how much that will affect the actual adoption of their services. But for example, they added a sports button in their Hisense VIDAA TVs that are currently sold in Walmart. They started selling those in Walmart during the Christmas season, right? So I don't know what kind of VIDAA television sets how many of those were sold in Walmart, but clearly it was a big shopping season. So, and there's a sports button from FUBO sports button attached directly on it. So I don't know if that provided the upside tailwind or not. Also, about on the share. They also added several CTV industry consumer revenue and other metrics in the actual broadcast television of these sports wagering. So basically, the amount of coverage that they were giving previously improved sequentially from Q3 to Q2 about players, about stats, about teams, and such. They also added more reporters on the network as well. I do not know if any of those qualitative things resulted in better attachment of consumers with the product in Q4 versus Q3. It is very, very hard to see. But overall, I think this company will do fine. And I think over the long term, this is a winner. That's it from me. Let's go to Jay.
Morning, everyone. Two quick updates on two stocks within the same industry. Stock number one is Hilton Grand Vacations. Ticker there is HGV. This is a vacation ownership timeshare company. It reported its Q4 earnings yesterday before the open. Shares would close higher by almost 6%. Now, to kind of start this off, JP Morgan thinks that the timeshare industry is sort of an underappreciated way to play the rebound in leisure travel. So now if we take a look at the earnings call, what did we find out? Management said that in the markets that they were open for for the full quarter, they recovered to 50% of the levels from 2019. Their tour flow in those markets also grew sequentially with strong performance in October, although the trend started to slow in November and December due to a COVID pickup. And that impact it varied by market. So for example, in California, a new stay-at-home order that moved to a full lockdown in December impacted occupancy. But in Orlando, they saw occupancy rates increase sequentially in every month of the quarter, and December actually produced its highest tour volume since the pandemic began back in March. Now, two other markets that they talked about. Number one is Japan. They said that Japan had another strong quarter and has recovered to 80% of 2019 levels. They also launched sales of their newest project in Okinawa during the quarter, and they hope to open that for occupancy sometime later this year. And then turning to Hawaii, they reopened their resorts and sales centers in mid-December and saw occupancy levels ahead of what they had saw in the mainland last summer. Forward bookings show improvements in projected occupancy levels as they enter the new summer month. Now, they did mention that there were some strict return protocols by the Japanese government that continued to limit the number of Japanese tourists visiting the island. So with fewer Japanese arrivals anticipated in the first half of the year, their Hawaii on-site sales center performance will be led by U.S. travel guests. So they continue to expect that they'll ramp up in Hawaii over the next several quarters, setting up a stronger second half and a solid run rate exiting this year. So this looks to be, trends are improving, but this looks to be a second half story. And then secondly, the other stock that I want to quickly mention is Marriott Vacations, ticker VAC. There was some small unusual call buying yesterday in the April 195 calls, which are now reflected in open interest today. Stifel was out with a note last night after meeting with management, and just some of the takeaways from that. The company said they have more reservations on the books for the second half of 2021, and the growth is pretty much throughout their entire domestic portfolio. They highlight that the older demographic for the company should lead to an earlier vaccination timeline. So the average age of ownership is around 60 years old, and with them receiving more of a high priority to get vaccinations, this could allow for the company to see elevate occupancy slightly before overall travel demand comes back. And then In terms of markets for VAC, they highlighted that they're seeing mid-70 occupancy in South Florida, low 70s in South Carolina, 75% in Colorado and Park City, and they also commented as well that Hawaii has bounced back nicely. So these are just two other names to keep on your radar as another way to play the reopening theme.
Excellent stuff. You know, the line that really catches my attention in this discussion here in this write-up is this one, the first one. The company has more reservations on the books for the second half of 2021 than at the same point in 2019. That just tells you there is a major pent-up demand that's out there. I mean, in 2019, nobody knew that there was a pandemic coming. And here, everybody is living with the pandemic, which is gradually going away, and there is far more reservations, 8% more reservations for the second half 2021. Goes back to the point we have been making now for several months that there's going to be a major pent-up demand for travel, for leisure, for all kinds of things, and we have discussed lots and lots of ideas related to that in past couple months. And these both VSC and HGV are clear beneficiary, and the trends are also very strong. Great stuff. All right, let's go to Chronicle.
Morning. So last week I shared a bullish idea on Steelcase, essentially talking about the anticipated return to offices, and similarly I've been keeping a watch list of several office REITs lately. One of them, which I'd like to talk about today, which I'm also considering bringing to the Outlook discussion, is Paramount Group, ticker PGRE. So this is a Class A office landlord with more than 70% of their $14 billion portfolio exposed to New York City. And as we can see from this image, they have significant exposure to high quality tenants, which is why their collections rate has stayed above 96% even throughout the pandemic. Currently, they have about $1.4 billion in total liquidity and $3.4 billion of debt, with almost $600 million of annual interest expense and $237 million in operational cash flow. So they are a bit levered, but I believe there's absolutely no immediate risk here. And another thing which clues me in that management thinks the company should be valued higher is that recently in November, they rejected a takeover approach for between $9.50 to $10 per share. Management also said in last month's conference call that they're working on renovating the One Market Plaza, which they expect will improve overall rental rates. Now, my bull case is simple and very similar to Steelcase. Basically, when I'm looking at sentiment right now, it seems to me like everybody in the media and sell side is talking about travel stocks and hotel stocks and casino stocks and retail stocks. However, I think you're noticing this too. Very few people are openly talking about the return to offices, and many office stocks are still trading at very depressed levels, like as though there's still some bankruptcy risk, and like as though working from home is going to be some sort of new paradigm for everybody. So just like my recent bullish calls on shipping, I think offices is another anti-consensus theme right now. So I wouldn't mind getting long this stock right here, especially given that it's trading very close to book value right now. And over the next several quarters, I would expect the stock to return near pre-COVID levels.
Very interesting out of box thinking, Chronicle, and this list is pretty strong here. Google, Showtime, Barclays, many of these companies that are blue chip companies that are their tenants, and 98% collection rate is also very impressive. And the chart technically looks fantastic over here. There is a major VOP resistance right here at $10 per share that goes back all the way to pre-COVID level. And the stock is attempting to break out through this on rather rising volume. And I've said this many times, anytime when something is coming up to resistance on rising volume, it's a precursor to a breakout, and then that could potentially propel the stock even higher sharply over time. That's the case over here. If it does so, there's a big air pocket in this name all the way to $12 per share. So that would represent about 20% to the upside. I would also mention that last week we briefly discussed that SPG, Simon Property Group, in which we used to be bearish for quite some time, but is now also in play with a bullish view, which also benefits from all these reopening themes. In fact, there was a note out from Morgan Stanley, I believe yesterday, also acknowledging the same kind of trends, in which they said that this company will now benefit from the reopening themes and improvements sequentially in all the metrics around rental rates, occupancy rates, and every single thing. So similar dynamics, except we're talking shopping malls with SPG and we're talking about office here with PGRE. Interesting pick, and I love the technical picture. Great stuff. All right, folks, we're going to stop over here. Thank you very much. We'll see you in the chat room shortly.